going to dial up the risk here a little bit here. This is not our normal, sleep well at night show.
To me, it kind of allows me to triple dip.
Within 90 days, we booked a 93% profit in advance auto.
In a best case scenario, we're talking 100% plus gains in 2 to 3 years down the road.
Hi, everyone. It's Brad Thomas, and welcome back to the Wide Moat Show. I'm joined today with my co-host, Nicholas Ward. And Nick, it's good to see you today.
Yeah, good to see you, Brad. Happy to be here. And today's an exciting episode. We're talking about high yield stocks, right? And that's not something we do all the time because we kind of focus more on sucker yields than we do on high yields. But today, we're going the opposite way and discussing how to generate a lot of yield with your portfolio.
Yeah, I think a lot of our readers and listeners over the last few weeks really like to see these higher yields. And obviously, who doesn't like high yield? And last week we did mention a few what so-called sucker yields, and these are companies that we want to avoid. But today we're going to recommend a couple higher yield companies that we both like, and then Nick, you're going to talk about some options, I believe.
Yeah, I think we'll start with me. We'll just get right into it here because Brad said he's got a list of several high yield stocks he really likes, but we also know as viewers, you guys like it when we don't go overboard with the duration time here. So I'll talk for a little while about what I do to generate yield in my portfolio, and then I'll pass the baton to Brad, and he'll use the remainder of the time to talk about the stocks he likes. So yeah, getting right into it, there are some high yield stocks that I like. A lot of them we talk about all the time here, so I didn't want to just keep, beating the dead horse, so to speak. So Realty Income, I love. I've owned it for a long time. Very happy to continue to own it. VICI is another company we talk about a lot here. It's got like a 5.2% yield. I like that a lot. About a month ago, and I'm wearing a flowered collared shirt in the thumbnail. You can go find it. When I was on vacation, we talked about BDCs. So I talked about, I think 3 or 4 BDCs that I liked. Blackstreet Lending, Main Street Capital, Ares Capital Management Corp. So those are all very high yield. We're talking 8 to 10%. I like all those companies as well, but I didn't want to just talk about the same names I talked about a month ago. So if you're interested in my opinion on BDCs, please go look at that video, and we can put a link in the description below. But what I do to generate yield in my portfolio is to avoid sucker yields. I'm not a big fan of just chasing yields. Brad and I talked about that for 20 minutes last week. Instead, I use very high quality companies to generate high yields using options. So a lot of people, when they think about options, they think about kind of using leverage. You pay a little bit of money and you're trying to make a lot of money. I kind of do the opposite. I take a lot of money and I'm trying to make a little bit of money. But in my opinion, there's very little risk in what I do. So let me explain I'll give 2 examples of trades. These aren't trades that I have on, and I'm not going to share my brokerage screen. There's just too much sensitive information there for that to happen. But these are the types of things that I do that, these are trades I've considered doing. So this will give the idea of kind of my strategy and how, somebody else might implement it if this is something that they like. So I think I've talked about this company before on this channel, Marsh and McLennan. It's the largest insurance broker in the world. Very low volatility, wonderful compounding. I'll throw a fast graph up and you can see just the earnings every year compounds, the dividend compounds. It's a low yield, I think around 1.8%. So not something you can generate high yield with. That's because the earnings growth quality is so high that the multiple is high. To have a high dividend yield, you generally have to have a low price to earnings multiple. And, so it doesn't work with high growth stocks. You don't get high yields. That's just not how it works. That would be too good to be true. But using options, you can generate high yield with Marsh and McLennan. So something I might think about doing, I have my brokerage screen up. I might consider selling a put on this company, which means, I have it up here, the September 19th put at $200, which means I would have to buy 100 shares for $200. So I have to have $20,000 sitting in my brokerage account. If I was to accept that, that per contract, I'm getting $350 per contract right now. Okay. So if you divide 350 by 20,000, I'm doing it on the calculator here, that's 1.75%. But that's just a 30-day contract that I'm talking about. That's the September 19th. So it's a little more than a month, right? So I'll go ahead and be generous. You times that by 12, you annualize it for the year. And that $350, if you were to do this once a month, you're at 21% yield on that $20,000. You're not going to be able to do it every month. My strategy is right now, I might like MMC. In 45 days, I got to find another company to do this with. If MMC is still cheap, I would like it. So what this means is if I was to do this, I'm saying I would be very happy to buy this stock at $200. Right now it's trading at 203. Say I think fair value is probably right around 200. Chuck Carnival would probably disagree with me and he would say it's a little lower, but I'm willing to pay up for very high quality companies with reliable growth. So if I like ticker symbol MMC at 200, I would say, sure, I'm happy to buy 100 shares. Go ahead and pay me that $350 per 100. And then if it goes below 100 by September 19th, I have to buy the shares. If it rises, like I suspect that it will, because I think fair value is probably at like a little higher, and the stock traditionally has traded at much higher multiples than it is today, then I don't have to buy the shares. I'm not going to get assigned the shares, but I get to keep my money, right? And they give you the money right away. So to me, it kind of allows me to triple dip. In my portfolio, the market's at all-time highs. I keep about 10% of my portfolio in cash. That allows me to have flexibility to buy dips, sleep well at night. I'm not worried about, if my hot water heater breaks, I can pay for it, et cetera. I never am 100% invested. Right now, I can generate about 4% just in a Fidelity money market account with that, with my cash position. That's great. A few years ago, you were generating, 1%. So 4% is like stealing candy from a baby, it feels like right now. But while I'm doing this trade, I still generate the 4%. Then I get the extra, 21% annualized yield on top of it. So then all of a sudden with my cash, with that $20,000 that I'm talking about for this trade, I'm at 25% annualized. So it might sound too good to be true, but it's not. The only risk here is that I am saying I have to buy MMC stock at $200. So if in a month, if it's trading for $180, I'm still buying it at $200. So yeah, in that scenario, I'm losing out, right? I picked the wrong strike price, but it's not a risk to me because this is something I might buy anyway. I might buy it at 200 anyway. So why not just collect an options premium, while we're going that? So before I just talk for 12 minutes straight, Brad, do you have an opinion on like cash levels? That's something that I go back and forth with people all the time. Mine hovers between 5 and probably 15%, depending on my kind of macro view of the world at the moment. Right now, I'm kind of right in the middle at 10%. Do you have an idea? Do you tell people, or for your own personal portfolio, do you have a cash position that you'd like to maintain just to kind of help yourself sleep well at night?
Yeah, well, first off, great job with explaining options. And I want to remind our viewers that we have an option service at Wide Moat Research that's actually run by, I think, one of the best traders that on the planet. And obviously, I'm biased, but Stephen Hester, you can go to our website at Wide Moat Research and look at his bio. But he's got really unmatched experience in trading. He's worked at some hedge funds. He's a CFA. He's managed other CFAs. But his track record is absolutely amazing. So please come take a look at widemoatresearch.com, our website. You can see Stephen Hester, CFA, is running one of our option strategies. To your point, Nick, again, I think everybody, kind of goes down to risk tolerance and what people are looking for. What I try to do is, basically as I earn income every month, I try to reinvest that income, and I take a certain amount of cash for me personally. But to your point, 5%, 10%. I mean, if you're investing in safe companies, blue chip companies, and we recommend a lot of these, here at Wide Moat, I would say probably 10% is a really good level. I'll tell you though, today in this current environment, I was actually at the gym this morning and I was talking to my trainer, and Connor's probably 25 years old. Hopefully Connor's watching the show. He usually tunes into our YouTube channel. And Connor played football at Clemson University, so go Tigers. But anyway, I was talking to my trainer, and one of the things that we discuss is his age, and obviously the younger you are, you don't have that much cash sitting around. So it's really important, not to really look at that 5%, 10%, 15% number, but just the frequency of it. You always have to be looking to invest and always trying to find those companies to invest because there are always investments. We try to point those out, every week on our show. At any rate, but I would say 10%, just on average, is a good level. But I think this market that we're in today is really interesting. Although I think we're seeing some high levels in the S&P, some of the companies I'm going to talk about here in just a minute are really attractive. So it's really important to always have some level of cash on the sidelines. I think 10% is probably a reasonable number, but again, it's really most important to always be investing in the market and looking at investing opportunities because there's always stocks that we can invest in.
No, I think that's a great point, right? Every month, as long as you're making money, I invest, you want a dollar cost average into the market over time. We talk about the best holding period being forever. And, the best time to plant a tree was 20 years ago. The second best time is today. All these kind of things that we say, that means you should be buying high quality companies consistently over time. And then before I pass over to Brad, I just talked about selling puts, which is when it's a company I'm using my cash to generate extra yield. Sometimes I use positions in my portfolio to generate extra yields by selling calls. So that means you have 100 shares of a company and maybe you want to sell it at a certain price. So you say, sure, I'll sell it at that price. And in the meantime, I'll collect a premium to do so. So an example I have here is Apple. Everybody that has followed me for a long time knows that I own a ton of Apple. I've owned it for over a decade. I have massive gains. Sometimes I do get a little scared about the valuation. And after the recent run up that we had last week, we're getting into that territory for me. I'll throw up a fast graph here and you'll see, this rally that we've had has pushed Apple up to a pretty high PE ratio and its growth isn't great, right? Apple trades at a premium because it's got so much cash on its balance sheet, such reliable income and revenues. It's a wonderful company, but it's trading for almost 30 times and its growth is, near 10%. That's not something I would buy, certainly. And it's even something I'm thinking about trying to trim a little bit. So one way to do that, and if I want to trim it now, I could, but I also could sell a September 19th call at a, say, $250 strike price, which means I would have to sell 100 shares of my Apple position at $250. That's not bad. The stock's already, that's another 10% higher roughly than we are today, I think. A little less than that. But, I'm making money more than I would today. And if I was to do that, I would collect about $120 per contract. So that might not sound like much, but if you divide 120 by $25,000 and annualize it, it's 5.75%. Apple yields less than 1%. So that's one way I can turn my 1% yielding Apple position into an almost 6% yielding Apple position just by, the risk here is that it runs to 300, right? If it runs to 300, I'm saying, well, I'm going to sell it at 250 and then I'm going to lose money. So you have to be willing to sell your shares in this scenario. But then if you want to be more aggressive, say, Apple's at what, 228 right now. What if I hate this valuation? If I was to say, sure, I'll sell it at 230, I just want to get rid of this stuff. Then you collect $700 per contract for that. And that starts to get a little better, right? If you divide $700 by $23,000, that's 3%. You times it by 12, you annualize it. Then that's a 36.5% yield, annualized yield. What if Apple just traded at 228 flat until now to the end of the year? That's the yield you would generate if you sold these monthly contracts. Obviously, it's going to change. So you do have to follow the market. You have to follow your stocks. You have to know your valuations, where you would sell, where you would buy. It's a lot of work. But if you want to do it, I just proved how you can generate a 20% yield with a very boring financial that yields 1%, and how you could use an Apple stock and get a 35% annualized yield if everything works out for you. And then worst case scenario, you sell your stock at a profit. So that's why I say I think this is low risk options investing. I get to pick the scenario of my outcomes. I'm either making money or I'm either buying or selling a stock at a predetermined price that I feel good about. So that's how I enhance the yield in my portfolio. And now I'm going to pass it to Brad. I'm interested to see kind of the high yield stocks he likes to kind of bolster his yield or theoretically in another portfolio that he might manage.
Great. And great job, Nick, here. So I'm going to move up the risk curve here. We're going to dial up the risk curve. This is a disclaimer. These three companies I'm going to recommend. They're not sleep well at night stocks. They're all small caps. And by the way, we have another product at Wide Moat called the Wide Moat Confidential, which is a small cap portfolio. It doesn't only include REITs. It includes a number of other companies as well. In fact, when I was preparing for this show, I was going to cover one company in this show here today, but I decided I'm gonna use that for my next pick here at Wide Moat Confidential, because we go for our really best, highest conviction companies. Actually, you can see in the background here that truck up there, Advance Auto Parts. That was my first development client, and Advance Auto Parts was one of our best picks so far in Wide Moat Confidential. We picked the company, I think it was in April, and within 90 days, we booked a 93% profit in Advance Auto. And again, it's a small cap because obviously they've sold off a lot. So there is higher risk in small cap stocks. And I just wanted to, again, disclaimer, I'm going to dial up the risk here a little bit here. This is not our normal, sleep well at night show. So the first pick here is a company called Plymouth Industrial. They're a REIT. Obviously, their ticker symbol is PLYM. They're yielding 6.7%. So what does Plymouth do? They're an industrial REIT. They own 133 properties of 205 buildings, which is over 30 million square feet. Now, their geography, and I'm going to show you this map here right now of where their assets are located, but they're located, you can see here, within what's referred to as the Golden Triangle. So you can see kind of basically all the way up from Chicago, Cleveland, all the way down to Jacksonville. And the reason that Golden Triangle is important is because this is a day's drive, most of these assets, to 70% of the U.S. population. And that's really kind of an important thing to consider, especially as we're really starting to enjoy this manufacturing boom that we've talked about quite a bit on previous shows. And the population growth in these markets is extremely attractive as well. So I think the assets are industrial. They're located in these very, very attractive markets. So the fundamentals are very, very solid. We actually came out with their second quarter earnings. Their NOI, same store NOI, that's their net operating income, grew 4.1%, which is extremely good. And also their occupancy is very strong at 96.5%. So balance sheet's in pretty good shape. Again, they're not investment grade rated. They're too small. Again, this is a small cap, but they've got around $285 million of availability on their credit line, and their debt's about 64% fixed. So no maturities this year in terms of their debt. So we think the balance sheet's in good shape. Again, they also reported annual rent escalators of 3.1%. Now that's significant because that's built-in organic growth for this company. Whether they do acquisitions or development, which they do both, they still are going to grow their rents by about 3.1% per year. So I'm going to pull up a fast graph here, and I'm going to show you the first chart. You can see valuation-wise, they're trading at 8.2 times. Nick, you pointed out earlier, I mean, obviously when you got these really low valuations, that means there's probably not a lot of growth prospects. And although this company does have growth, we don't see anything close to double digit. So they're trading at 8.2 times. Their normal valuation is closer to 12.4 times. And I've also highlighted the growth, the analyst growth forecast for the company, which is around 5%. So not bad. That's for 2026. So overall, I like the company. Again, higher yield. I think the setup is really good. Again, that 6.7% yield, very well covered payout ratio. So I'm not fearful of a dividend cut. Payout ratio is about 54%. So again, you're getting a 6.67% yielder, 54% payout ratio. I believe, and I'll pull up this next chart, I call it my best case setup, which means it's not my optimistic, it's not my pessimistic, it's my best case scenario, is this company could return 30% annualized really over the next 12, 24 months. We think that's fairly significant. So you're getting a really attractive yield plus the potential for really attractive total returns. The next one I'm going to go into.
Well, before you go on, Brad, that's interesting. I didn't know you were going to talk about Plymouth today, but just describing that, I just wrote an article to our subscribers at Wide Moat Letter talking about the story your daughter broke, Union Pacific, acquiring Norfolk Southern. And during that presentation, they talked about the Ohio River Valley, the Mississippi, the Ohio Valley, the middle of the country where those two networks combine. They're going to see massive synergy, massive growth in that area of the country. So I've been trying to use some second, third level thinking. What other companies might benefit from that, right? If this merger goes through in 2027 and we get a true transcontinental railroad that really bolsters growth in the center of the country, what are some other companies that are going to benefit It sounds like Plymouth might be one of them if they own, a bunch of warehouse properties in that area. That's something to think about, for me personally and for everybody else. That railroad merger is going to take a year and a half, 2 years to close. But if it does, it sounds like Plymouth's footprint is where a lot of growth is going to happen, economically from a macro perspective, and they should benefit.
Yeah, and you combine that with the AI demand, which all this data center growth, and what's really interesting, if you lay over the top, the railroad growth that you mentioned, that's a great point, and the insatiable demand for AI and these new data centers and all the energy. I mean, you're going to find some really attractive markets, and it really does come down to real estate at the end of the day. I mean, that's really important. So the next pick, which is also a company that operates within the Sun Belt, really the smile states of the U.S. So it takes us over to Texas and Las Vegas and Arizona. Company's called Global Medical. The ticker symbol is GMRE. Again, another fairly high yield, 7.2% yield. Now, this company operates healthcare. Now, they're net lease property, so the tenant pays for the expenses, the taxes, insurance, maintenance, etc. So this is a net lease healthcare REIT. They own 191 properties, primarily leased to physicians groups and regional and national healthcare systems. 4.9 million square foot portfolio, 297 tenants. Primarily, they operate medical office buildings, which is about 71% of their portfolio. Then they have some inpatient rehab, which is at 17%, some other stuff at 12%. You can see from this map, this is the geographic representation for Global Medical. Very diversified. Texas is the largest market at almost 15%, and Florida is the second largest market at 12.4%. Ohio's 8.8%. So a lot of properties, again, located in very attractive growth markets. Now, one of the sell-offs, again, there's always, obviously, these companies have all sold off, which is what generates these higher yields. But Global Medical had a tenant called Prospect Medical, which filed for bankruptcy earlier this year and was reorganized. But Global Medical only had a very small percentage, about $2.4 million of lease payments directly associated with the 3 properties that were leased to Prospect Medical. So it's less than 1% of Global Medical's rent. So that's kind of a headline risk. We think that's overdone. Now, on the latest earnings call, I just pulled this up. I want to read this to you. The company said, our highest priority is the balance sheet to renew the portions of our credit facility that are coming due in 2026, namely the revolver and our $350 million term loan. The company said it was in active discussions with lending group to renew that loan, and it should be in place by about the fourth quarter of this year. So that's another kind of overhang or risk. But again, the company is looking to extend its credit facilities and improve its balance sheet. It also reported, and this is another risk, but it's already happened. So the company cut its dividend, and we actually knew and predicted the company would cut its dividend because it was kind of in that sucker yield status, earlier this year. But now they've reduced or cut or right-sized the dividend from 21 cents a share to 15 cents a share. So they have adequate coverage now in terms of their payout ratio. Now, more recently, the company got a new CEO. And actually, I know this guy extremely well. It's Mark Decker Jr. I know his dad, Mark Sr. I've known both of them for quite a while. So Mark is now the CEO of Global Medical. He has 30 years of capital markets experience. He was at BMO and other places. And he's had 20 years of investment banking. And then most recently, he was the CEO of a company called Center Space, which we cover. It's a multifamily REIT. So I think, that's certainly a good sign. But more importantly, when Mark took this job as the CEO, he put $1 million of his own money into the stock. So he's got skin in the game. It's a brand new job. He's convicted to really grow this company and create value for shareholders. I've spoken with Mark a couple times since he became CEO and really excited about what he's going to do with the company. Now, the company's really cheap. You can see here from this fast graph, they're trading at 7.3 times. Their normal valuation is closer to 12.2 times. Again, their dividend yield is really attractive, 7.2%. They've already cut the dividend. So again, I'm not fearful that they're going to cut it at least anytime soon. And again, Mark's in charge now. He's running this. He's focused on his balance sheet, improving shareholder value. So I think this is a really attractive opportunity. As you can see here in the next fast graph, my best case, again, not the optimistic, not the pessimistic, the best likely, my best case scenario is the company could generate over 30%. Actually, I've got close to 35%, and that's our best case. I'm not trying to be sugarcoating here, 40, 50%. But I think there's a really good chance this company could generate some very attractive returns. But in the interim, while we're waiting, you've got a very, very attractive 7.2% dividend yield. So that's the healthcare REIT.
That's annualized, right? That's 35% annualized.
Yeah, annualized.
So that I mean, you're talking triple digit gains 3 years down the road in the best case scenario.
That's correct. That's correct. The last pick is another small cap. Again, we move that, dial up that risk here. This company's called Armada Hoffler, AHH. We've actually had some readers or viewers ask us about Armada, so hopefully I can answer that question here. And by the way, if you have any other ticker questions or you want us to research certain companies, please drop those in the comment stream below, and we'll try to jump on those as soon as we can. But Armada, I know, was a question. Armada is an interesting company, and I like the company. Being a developer in my previous life, Armada does develop. They're a developer. They actually have an in-house construction company, so they're fully integrated. They primarily own and operate and develop mixed-use properties. So whether it's retail, whether it's office, or apartments, multifamily, they operate those types of assets. Sometimes they come together as a package, which is a mixed-use product, or sometimes individually they'll develop those. The portfolio is about 6.2 million square feet of commercial buildings and about 2,500 multifamily apartments. Of those mixed-use properties, about 58% of the revenue stream within the portfolio are those mixed-use properties where they bolt on all those different property sectors together. They're primarily located in the Mid-Atlantic and Southeastern markets, where, of course, I live. And they have two really core projects in their portfolio, which are mixed use. One is called Town Center. It's in Virginia Beach, and that's where the company's based, by the way. And then they have Harbor Point in Baltimore. And I was in Baltimore last week. They've got one building specifically in which T. Rowe Price is one of their anchors. They just opened their global headquarters there. And on the latest earnings call, Armada said the retail sales within that Harbor Point area, mixed-use area, is up over 20% as a result of the T. Rowe Price relocation there. So that's a pretty significant asset in the portfolio. Now, there are risks because they do have high concentration in Baltimore and in the Virginia Beach area. Now, in terms of their balance sheet, again, you're not going to get investment grade ratings per se. Actually, they have moved into the investment grade category, but right now they're trading their debt to total adjusted EBITDA is about 7.7 times with a liquidity of about 172 million. They did earn a triple B rating, by the way. So kudos to them. Again, they're a small cap company. Now, they reaffirmed their FFO guidance, their earnings guidance from $1 to $1.10 a share. So again, very stable. And they did cut the dividend historically, again, much like the previous Global Medical. So right now, their payout ratio is in fairly attractive shape. Now, in terms of their valuation, you can see here they're trading at 8.4 times compared to their kind of more normal valuation of 14.4 times. So we see that wide margin of safety there. The dividend yield is 8.1%. And again, we think the opportunity set is very attractive. As you can see in this best case chart here, we think this company could deliver 30% annualized returns. So again, these are three small cap REITs. They're all paying high dividends. We think the payout ratios are in good shape, and we think the companies can grow and generate added value for shareholders, especially because these are somewhat depressed prices.
So Brad, my question to you, I love hearing about, all three of these in a best case scenario, we're talking 100% plus gains in 2 to 3 years down the road. Obviously, I hear that. Anybody hears that, they love it, right? There's no way the S&P 500 does that. But they obviously come with risk. They're this cheap for a reason that those returns kind of would rely on multiple expansion back from their really depressed multiples that they have today, back to the 12 to 14 times historical averages. For that to happen, sentiment's going to have to change. We can't predict when or if that'll happen. We don't know. So what would I asked you this about cash earlier, 5 to 10% cash allocation in a portfolio. What in a typical portfolio, and I know this depends on per person, per risk, et cetera, how much capital would you allocate towards these like kind of deep value, admittedly more risky kind of small cap, bets, for lack of a better word, in a portfolio? I know we talk about these as yield enhancers, So, you've got your, very high quality mixed use property and maybe federal realty, and then FRT, they're trading for 25 times. So they're much more expensive. And then you can maybe marry that with, the company with the assets in Baltimore and Virginia Beach, and then you get a much higher yield. So what's your strategy there on allocation with these risky or small cap properties?
Yeah, and before I answer that question, let me also mention that we have a common catalyst for all three of these companies. In fact, just the REITs in general. Obviously, we think there's a very high probability now of a rate cut finally. And also, these three REITs are all in very attractive growth markets. So I think when you combine the locations, obviously these sectors trade. That's the great thing about investing in REITs. You can build portfolios based upon different risk reward kind of risk tolerance levels, I guess. But all these have kind of this common catalyst within the REIT space that we think there's a very high probability now of a rate cut and potentially a rally that could unfold here with real estate within certain sectors. Now, to answer your question, and I could go into long detail. In fact, I think we should maybe even try to have a show on this particular question. But I think it really comes down to what I like to try to suggest or recommend is building not only your REIT portfolio, but building your income portfolio, utilizing what I call this anchor and buoy approach. So I think what you would want to do, and my suggestion, is to build these portfolio. Just say you have 20 names in an income portfolio. And again, it can be REITs or it could be just income in general, BDCs and MLPs and other income stocks. But whatever it is, say take 20 names. You want to anchor that portfolio. And when I say anchor, let's say 75% allocation to these sleep well at nights, to these blue chip companies that have never cut their dividends, that have very excellent payout ratios, that have great management, that have good balance sheet, good earnings forecast. So, we want to take, say, 75% of those being swans. And then 25%, again, it could be 20%, it could be 10%. Again, it's depending on risk tolerance, but same model, you just dial in whichever you want to that, what I call the buoy. So you have anchors and buoys. The buoy is higher risk. It's going to give you yield enhancement. That buoy could be just preferred stocks, and we could actually do a show here on preferreds or bonds, but we want to have very, very stable, high income, mortgage REITs too. We've talked about just a few mortgage REITs we like, not many. But you anchor it with the swans, and then you build out a 20, 25%, maybe it's a 15% slice of higher income. And so that's kind of my overall kind of suggestion, not knowing anybody's risk tolerance who's watching this show. I would definitely anchor it with swans and then build out the yield enhancement with these companies. And obviously, you've got to research these companies, which obviously we do here at Wide Moat Research. That's generally, Nick, how I would answer this. I would definitely not go all in to these higher yielding companies like the ones I just referenced. I think there's definitely risk, small cap volatility, et cetera, but nothing wrong with dialing in a certain percentage of these, higher yielding stocks. But again, it's all going to come down to the individual investor's risk tolerance.
No, I like that. I like that answer a lot because I think everybody's got that itch. You hear about, I don't follow any of the companies you mentioned today very closely, and two of them I've never heard of before. But you made a pretty compelling argument. I'm going to start researching them this afternoon. Maybe I'll go buy some shares because just the risk reward is very attractive. But everybody needs to understand when you're talking about triple digit upside, there's obviously downside to it. You can't have one without the other. So, but I think that makes sense. Everybody wants that triple digit upside. Just get a little bit, scratch that itch, know it's there, know, hey, maybe I can hit a home run. But, for most of your at bats, you're up there just trying to hit singles and doubles. And because over the long term, with compounding, those swans will make you rich. We've proven that again and again on this show and with our model portfolios, and we'll continue to do that, Brad. But I do like your idea of maybe next week talking about an asset allocation, how to maybe build portfolios for different times in your life, different risk tolerances. So that's an interesting subject. Brad and I can get together this week and kind of talk about how we would put that together for a YouTube show. But I think that could be valuable for viewers. And I look forward to, thinking about that and working on that over the next week. But until then, we're about 35 minutes here. I think that's a good time to end the show. We hope you guys enjoyed it. Like I said at the intro, we don't often talk about super high yields like this because neither Brad nor I really want to take outsized risk. We don't want to chase yields. We don't want to speculate. But here's some interesting opportunities. Hopefully you guys kind of like this change up. And if you did, please like and subscribe to the video, to the channel, and help us keep growing. I think we're going to hit 5,000 subscribers this week. So, thank you guys very much. That was one of our early goals, now on to 50, 100, etc. So thank you guys for watching, and we'll see you next week.
Thanks for watching this episode of the Wide Moat Show. Please like and subscribe below. And also, please join us at the Wide Moat Daily for our dose of daily news. You can visit us at widemoatdaily.com. Thanks for watching us. Have a great day.